The Moving Average Convergence Divergence, MACD, multi-time frame analysis is one of the most effective and widely used methods in technical trading for identifying trends, momentum shifts, and potential entry and exit points with greater accuracy. The MACD itself is a momentum oscillator that measures the relationship between two exponential moving averages, EMAs, usually the 12-period and 26-period, while the signal line, typically a 9-period EMA of the MACD line, provides crossovers that signal potential buy or sell opportunities. However, when traders apply MACD across multiple timeframes, say combining signals from the 1-hour, 4-hour, and daily charts, they unlock a much deeper understanding of market behavior and trend strength. The idea behind multi-time frame analysis is simple yet powerful. Trends that align across multiple timeframes are generally stronger and more reliable than those that appear in isolation. For instance, if the MACD on the daily chart shows a bullish crossover while the 4-hour chart confirms rising momentum, it suggests that the overall trend direction supports a long trade, and the lower time frame offers a favorable entry point with reduced risk. Conversely, if the daily MACD shows bearish momentum but the shorter time frames are giving mixed signals, it may indicate short-term corrections within a broader downtrend. Traders use this alignment principle to ensure they are trading in harmony with the dominant trend rather than getting caught in short-term fluctuations. A key benefit of using MACD in multiple timeframes is the ability to filter out noise and false signals. On lower timeframes like the 15-minute or 1-hour chart, the market can often produce misleading crossovers due to volatility. But when the same crossover aligns with the higher time frame trend, it acts as confirmation, strengthening the trader's conviction. For example, if you see a bullish MACD crossover on the 1-hour chart, but the daily chart's MACD line is still below the signal line, it might be best to wait for confirmation from the higher frame before entering a trade. On the other hand, if both the daily and 4-hour MACD are above the signal line and showing widening histogram bars, it indicates strong bullish momentum, and pullbacks on the 1-hour chart may serve as excellent entry zones. This combination of long-term trend identification and short-term precision makes multi-time frame analysis with MACD a complete system for disciplined traders. Furthermore, the MACD histogram, which represents the difference between the MACD line and the signal line, plays an important role in identifying momentum changes. When used across timeframes, the histogram helps traders visualize acceleration or deceleration in price movement. For instance, if the daily histogram is expanding in positive territory, it confirms strong bullish momentum. If the 1-hour histogram starts contracting, it might suggest a temporary correction or consolidation before the next upward move. By synchronizing these observations across timeframes, traders can better time their entries, manage their risk, and avoid getting trapped by short-term reversals that go against the dominant trend. Another valuable aspect of MACD multi-time frame analysis is divergence. Divergence occurs when the price moves in one direction while the MACD moves in another, signaling potential reversals. Spotting divergence on higher timeframes such as the daily or weekly chart can reveal major turning points, while lower timeframes help fine-tune the entry once the reversal begins. Professional traders often combine MACD with support and resistance zones, candlestick patterns, and volume confirmation to increase accuracy. For example, a bullish MACD crossover on the 4-hour chart that coincides with price bouncing off a daily support level offers a high probability setup. Similarly, traders might use the 15-minute or 1-hour MACD to fine-tune their entries within the context of the 4-hour or daily trend. The goal is to trade in the direction of the dominant trend while using shorter timeframes to identify optimal timing. This approach helps in minimizing drawdowns, improving risk-to-reward ratios, and enhancing consistency. In essence, the MACD multi-time frame strategy is about aligning short-term precision with long-term direction. It allows traders to think like investors, focusing on the big picture, while acting like scalpers, taking advantage of short-term opportunities within the broader trend. The power of this technique lies in its ability to synchronize timeframes, filter out market noise, and provide clarity in decision-making. In the fast-paced world of trading, where conflicting signals and emotional impulses can easily lead to losses. The MACD multi-time frame analysis serves as a disciplined, structured approach that helps traders stay aligned with market reality. By mastering this method, traders gain the confidence to identify true trend continuations, anticipate reversals before they occur, and trade with precision that reflects both the art and science of market timing.